Today we are going to talk about capital budgeting. Capital budgeting is a really critical part of any business and any business planning process. And when we talk about capital budgeting, what we're talking about is planning for big purchases, usually capital assets. Okay, so what are those? So it could be something like buying fixed assets, right? Could be buying vehicles, maybe replacing an entire vehicle fleet, maybe a single vehicle. Maybe we're gonna build a new plant. Maybe we're gonna build a call center. Maybe we're gonna buy another company. Maybe if we manage apartment units, it's going to be re-roofing our apartments. But it's basically planning for big purchases. And the assumption is that we have constrained resources, okay? So we have a limited amount of money and or a limited amount of time. So if we did not have constrained resources, then we just buy whatever we want, right? I mean, if we're just sitting on a giant pile of cash and we could say, hey, let's go build a new plant, let's buy a corporate jet, and let's replace all of our vehicles, and we could do this all the time, and we wouldn't have any need for capital budgeting, and we'd be happy as clams. But in the real world, very few, if any, companies have unlimited resources. So capital budgeting is a way to plan for our expenditures and to also make decisions between different expenditures, okay? So let's say we want to replace a vehicle and we want to put a new roof on our facility and we want to acquire another company. And we have a limited amount of money and we can only do one of those things. What capital budgeting will do is it gives us some tools where we can compare each of our options, our investment opportunities, and then we can use that analysis to decide which one is going to be most profitable for our company. If we are making these investments without emotion, which again is rare, but if we were, then we would want to do it strictly by what's going to make us the most money. Okay, so there's three different parts of the investment opportunity we need to take into consideration. The first is the acquisition phase. What's it going to cost us? What's it going to cost us to buy a new vehicle or to build a new plant? The second is the use. And this is where we figure out, by making this investment, how much more money are we going to make? And what are the costs associated with it, okay? So what's the net income or the cash flows associated with having this asset? We have to think of everything from revenue, expenses, maintenance, whatever it's gonna cost us to have this asset generate money for us, generate revenue, generate net income. And then finally, we can also factor in the disposal. And we're not gonna talk about that a lot in this unit, but if we can buy a new vehicle for $50,000 and it's going to make us $10,000 a year, and at the end we can sell it for $5,000, right? You remember salvage value. Then we would incorporate that into the overall cost of the investment when we calculate which of our investments is going to make the most money. Okay, so we are going to learn 4 different tools that we can use to assess different investment opportunities. Don't ever use just one of these. If you use just one, you're going to get some very skewed results, and we're going to talk really quick about advantages and disadvantages of each of these. Use a couple. Use all 4 if you want to. And different investment opportunities are going to show up differently based on the analysis tool you use, and so then you can kind of get a broader picture of what's going to make sense, okay? All right, so you have room on your worksheet to write the advantages and disadvantages, and I'm going to talk to you about those right now. So our 4 methods are payback, accounting rate of return, net present value, and internal rate of return. The top 2, payback and accounting rate of return, do not use time value of money. Net present value and internal rate of return do use time value of money. So we'll be using some of those skills from module 14 when we did time value of money. All right, so payback. I like payback because payback is quick and easy. And payback is basically, it's like break even. How long is it going to take us to get our money back? It's also called payback period. Okay, so the advantages are it's easy and it allows comparisons between projects. The disadvantage, it ignores time value of money, and it also ignores cash flow after payback. So I'll give you an example. So we were deciding whether to get solar on our house. So we got the estimates for solar, how much it would cost to get the panels put on the roof, and then we also looked at how much on average were we paying for electricity every year. So I took the amount for the panels, I divided it by the amount we would save by not having to pay for electricity, and I think our payback ended up being something like 5.5 years. So then my husband and I decided, well, we'll probably live in this house for more than 5.5 years, so this was a good investment for us because we would make our money back, and then once we make our money back, then we're in the clear and we're just getting free electricity, okay? So that's payback. Accounting rate of return is also very easy. The ones that don't use time value of money are easy. And so the advantage is it's easy and allows the comparison of different projects. It ignores, where are we? The time value of money. And it also ignores different net income rates over time. So payback is going to use cash flows. Accounting rate of return is going to use net income. If cash is a concern for your company, then payback is going to be kind of better because it actually looks at cash flows, whereas accounting rate of return looks at net income, so you're going to have some non-cash expenses in there. All right, net present value, that's basically going to look at, if you look at how much you're going to pay and then the present value of all of the expected cash flows you're going to get, then are you going to make enough cash flows to cover the cost? So the advantage is it does reflect the time value of money, and it reflects varying risks over the project life, but it is more difficult to compare if you have dissimilar projects, right? Maybe one project is going to cost you $1 million, one's only going to cost you $20,000, and those are going to be harder to compare. And then the final is the internal rate of return. And so that one is where we calculate what kind of return are we getting on our investment, okay? What would be our internal rate of return if we invested $1 million and we got $20,000 a year from it? What kind of return are we getting on that? The advantage is it reflects the time value of money, and it does allow comparison of dissimilar projects, but it ignores just the varying risks over the project life. Okay, and then the last thing I want to talk about is the hurdle rate. So we as a company will set our hurdle rate, and the hurdle rate is what is the minimum amount we want to make off an investment opportunity. What is the rate we have to hurdle? I'm not going to try and hurdle because I'll hurt myself. So for example, say I've got a bunch of money and it's sitting in an investment account and it's making 5%. Any of my investment opportunities that are going to make me less than 5%, why would I even risk it? Just leave the money where it is, collect my 5% every year, and I'm done, okay? So then my hurdle rate would be 5%. So I'm not even going to look at any investment opportunities that don't give me a rate of return that is at least my hurdle rate. And usually my hurdle rate is kind of what I feel like I can make if I don't invest in anything. Okay, so we're going to go into the computer. We're going to look at a few examples of these, and then we're going to get to it. All right, see you then.